All right. So I know it's bright and early, so let's start the webinar. Good morning, all again. Thank you for joining us for the first of two sessions of the ASC 842 Lease webinar. Just a reminder, the second session will be on October 7th. Before I introduce myself, let me share with you some housekeeping items. Please submit any questions you have via the question feature on the webinar control panel. We'll do our best to answer your questions during the presentation, but if you're not able to do that, we'll follow up after the webinar. Second, the presentation slides can be downloaded from the handout section of the webinar control panel, in addition to other helpful materials. This webinar qualifies for CPE, so for those who need CPE credits, polling questions will launch throughout the webinar. They will need to be answered in order to receive CPE for attending the presentation. All right, so those are the housekeeping items. My name is Sikich Babu. I'm an audit partner in a for-profit practice group, providing financial statement consulting and attest services, including audit, review, and compilation for our companies, primarily in the manufacturing and distribution industry, business and professional services like law firms, engineering firms, staffing companies, technology service companies. I'm glad you could join us today for the webinar. And this morning, Cheryl Bayer and Greg Fiedler are joining me on the presentation. Let me request each of them to do a brief self-introduction. Cheryl?
Hi, I'm Cheryl Bayer. I'm a manager in the for-profit assurance practice at Sikich.
Thank you, Cheryl. Greg?
Hi, I'm Greg Fiedler. I am the firm's Assurance Director of Innovation. I've been serving in this role for about a year now, and prior to that, I spent 14 years doing audit and assurance services for commercial clients and state government. So happy to be with you here today.
Thank you, Greg. So let's move to our agenda for this session. All right, we'll start off by providing an overview of ASC 842, including the effective dates, the scope, that is which leases are included within ASC 842 and which are out of scope, and the transition methods. There are two accounting methods available upon adoption, right? Then we look at lease identification, how to identify a lease, including embedded leases, lease components and related payments, including non-lease components and non-components, lease classification, the finance lease and operating lease, what the criteria are for those, related party consideration, including the concept of legally enforceable terms and conditions. Transition considerations are various things to consider during transition, including policy elections and practical expedient, which are available upon adoption. And last but not the least, the various Sikich implementation tools that are available to help with the implementation of the new lease standard, including our proprietary lessee ledger. And please note, throughout the presentation slides, we'll add two signs, which you can see on the screen, indicating policy election and practical expedience. All right, let's do an overview of the new lease accounting standard. The current lease standard, ASC 840, will be replaced by the new lease standard, ASC 842. We will share more information about the effective dates in a later slide. Operating leases, I think this is the biggest change that's happened in the new lease standard. The new lease standard require operating leases to be recorded on the balance sheet. Very limited exceptions apply. They will be recorded in the balance sheet in the form of a right of use asset and a related lease liability. The right of use asset will be a long-term asset, and the liability could be current and long-term liabilities. So that we think is the biggest change, because the current standard, only the capital leases are shown on the balance sheet. Debt covenants of financial ratios, we think it's very likely the new lease standard may impact some debt covenants, including covenants such as the debt service coverage ratio, debt to equity ratio, and current ratio, to name a few. Lease classification. The current lease standard has two lease classifications, the operating lease and capital lease. The new standard also has two classifications, but the capital lease is called finance lease in the new standard. Embedded leases. Again, identification of embedded leases is emphasized in the new standard. Although the concept of embedded leases is not new, since operating leases are carried on the balance sheet under the new standard, embedded leases becomes a bigger deal and has a larger impact under the new standard. Cheryl will share more information about embedded leases later in the presentation. So unlike the current lease standard, certain lease-related payments, in addition to base rent, may be incorporated in the right of use asset and lease liabilities, such as initial direct cost, lease incentives received will be included in ROU, the right of use asset, and items such as variable lease payments that depend on an index or rate will be included in lease liabilities. Financial statement disclosures, the new lease standard require much more accounting lease accounting related disclosures compared to the current standard. And Greg will share more information about that required disclosures during his presentation of the lessee ledger. Let's go to the effective dates. All right, so for public entities, including not-for-profit entities, the new lease standard was effective for fiscal years beginning after December 15, 2018. However, the effective date was deferred by another year for certain public not-for-profit entities that had not issued the 2019 audited financial statements on or before June 3rd, 2020. For those entities, the new lease standard was effective for fiscal years beginning after December 15, 2019. So fiscal years 2020, 21, the ASC 842 applying. For private entities, it's effective for fiscal years beginning after December 15, 2021, that is end of this year. And for interim financial reporting, it's effective from the second year of adoption. So interim periods beginning after December 15, 2022. Scope and scope exceptions. So ASC 842 applies to nearly all leases, including subleases. So companies who sublease their facilities would have to follow the lessor and lessee accounting based on the new standards. Also, the new standards apply to related party leases. So there's no difference between related party and third party on related party as far as ASC 842 accounting is concerned. It's all the same. There are some limited exceptions. ASC 842 is not applicable for certain items which is listed there, including intangible assets, inventories, asset under construction. If there are any lease related to those items, those are not covered under ASC 842. Then short-term leases, as marked, this is a policy election. A company could opt for a policy election to not adopt ASC 842 for short-term leases. So what's a short-term lease? A lease that at the commencement date has a lease term of 12 months or less and does not include a renewal or purchase option, which the lessee is reasonably certain to exercise. I'll just repeat that. I'll just read that one more time. A lease that at the commencement date has a lease term of 12 months or less and does not include a renewal or purchase option, which the lessee is reasonably certain to exercise. So for those short-term leases, a company could opt to not account it under ASC 842. Another policy election would be the companies to have a minimum dollar threshold. So this is very similar to companies having an accounting policy of not capitalizing any asset below say $1,000 or $2,000, some nominal dollar threshold. So a company could have a similar policy for lease accounting. So anything below an asset with fair value less than say $2,000 or net present value of the lease payment less than anything less than 5,000 we think is reasonable. More than that may not be an appropriate threshold. Transition methods. So upon adoption, there are two optional transition methods. One is the comparative reporting and the other is non-comparative reporting. For comparative reporting, ASC 840 accounting is applied retrospectively to each prior period presented. So with the cumulative adjustment made to beginning of the earliest comparative prior period. So just to give an example, let's say we're implementing ASC 842 as of January 1, 2022. So 2022 would be your current year with 2021 as a comparative prior period. So if you're using the comparative reporting method, you would present your financial statements under ASC 842, both for 2021 and for 2022. The cumulative adjustment upon adoption will be affected as of January 1, 2021. Okay, so that is a comparative reporting. For non-comparative reporting, basically your 2022 would be under ASC 842 and 2021, the comparative will be under ASC 840. So 1 year will be under 840 and the current year will be under 842 with the cumulative adjustment affected as of January 1, 2022 on the year of adoption. We think many of our clients might go for that option because that's an easier of the two options to adopt. All right, looks like we have the first polling question. Let's see. Let me read the polling question. How prepared are you to implement the new lease accounting standard, ASC 842? You have 5 options. This webinar is my first introduction. I hope it's good. I have done a little research, but not feeling ready. I understand the new requirements and need to collect data. The data is ready, but need to pick an accounting solution. Already done, just here for CPE and updates. So I think if someone is choosing the last option, already done, congratulations. I know you're glad that it is done. The heavy lifting is done. I know the new lease standard would require you to, you can't really forget after implementation. You may have to do some, if there are amendments or revisions to the lease agreement, you may have to make changes. All right, so the results are in. Close between the second and first option. So I've done a little research, but not feeling ready. I think many, just like in the result of this poll, many might be in that bucket. So we are here to help. All right, I think the next session of our presentation, Cheryl Bayer will take over. Cheryl?
Thank you, Silas. Okay, so once you've determined which agreements are in or not in the scope of ASC 842, a logical next step would be identifying your company's leases. Preparers will do this using new control-based definitions that are provided in ASC 842. The new standard defines a lease as an arrangement that conveys the right to control an identified asset for a period of time in exchange for consideration. An arrangement that lacks any of these elements would not be considered a lease for ASC 842 accounting purposes, and it would be accounted for under other GAAP in that case. We've prepared this depiction as a visual summary of the considerations that you would make. We'll go left to right on the bottom now to talk about these criteria. So starting on the bottom left, you can see that identified assets may be explicitly identified. For example, a vehicle that's identified by its unique VIN number or a designated floor of a building. Those would be examples. Identified assets can also be implicitly identified in some cases. Moving on, there has to be a lack of substantive substitution rights available to the lessor for there to be an identified asset. If a lessor has the ability to substitute the assets during the lease, and if the lessor would benefit economically from exercising that right, there would be no identified asset in this scenario, and the arrangement would not be considered a lease. The asset must be physically distinct to be an identified asset. It can be an entire asset, like a piece of equipment, or a portion of an asset, such as a retail space within a mall, or a floor of a building. Moving on to the category of control, we have the concept that to be a lease, an agreement must provide substantially all the economic benefits to the customer. A customer can obtain economic benefits in many ways, including by using, holding, or subleasing that asset. To have control, a customer also needs to have the right to direct the use of the asset. This includes being able to make key decisions about how and for what purpose that asset will be used. Moving lastly onto periods of use, in the application of 842, non-consecutive periods of use are considered. For example, contracts that are in effect only for certain periods of the year. And periods of use include options to extend the term for periods that are reasonably certain to be exercised. In addition to the prior diagram, you may find this useful in practice as you assess whether various contracts meet the definition of a lease. This one goes a little deeper into the concepts of control. It includes some additional considerations that come into play when the use or design of the asset is predetermined in the contract. And preparers need to assess who has the right to direct the use of the asset in this case, the supplier or the customer. I guess this is a good time to just reiterate that our presentation is an overview. If you were to print the text of ASC 842, you would find that there are 15 pages of examples of different hypothetical contracts illustrating what would qualify or not qualify as leases. So there certainly can be some detailed questions that arise as you identify leases in your organizations. And it's conceivable that you may want to consult guidance in ASC 842 or reach out to your Sikich team to discuss the questions and things that you're finding. Continuing our discussion of lease identification, we introduced the concept of embedded leases, which are agreements that are not traditionally thought of as leases, that contain terms and provisions that meet the criteria of a lease. Embedded leases will also be recorded under ASC 842 if the lease identification criteria summarized on the previous slides are met. Examples of these may include certain of the following arrangements listed here, such as purchase agreements for consumable items that entitle a customer to free equipment, supply agreements, IT services like networking or cloud computing services, contract manufacturing agreements, etc. As you consider this, especially think about service agreements where assets play a key role in providing the service to you. What's important to know is that your organization should evaluate other contracts in addition to traditional leases to consider whether they require lease accounting as well. Okay, we move on to a big topic here. Continuing into the next step, after you've identified your leases, lessees will need to gather information about various payments associated with the leases. This is a new element in the process that was not required in the past for lease accounting. I will comment here also that by the time you reach this phase of implementation, you may find it helpful to use a template to start collecting and organizing various pieces of information about your entity's leases. Depending on the size and complexity of your lease portfolio, you may want to gather as much relevant information from your lease documents, trying to do it in one touch to the extent possible. Sikich has a spreadsheet format that you might consider using, and Greg will mention it later. In any case, there are new aspects of lease accounting that will require entities to identify and categorize payments relating to their leases. Lease-related payments need to be identified for purposes of determining lease classification, which we'll talk about more in this training session, and later for measurement of ROU assets and lease liabilities. We'll talk about that piece in our next session on October 7th. This slide summarizes the payments that lessees may make, which are grouped into 3 categories that have unique meaning and accounting treatment. The first category is lease components. These are payments that provide the right to use an asset. Your typical base rent or lease payments are in this group. Payments in this first category will be included in the determination of lease classification and in the calculation of ROU assets and lease liabilities. The second category is non-lease components. These are payments that transfer a good or service related to the use of the asset, but not for use of the asset itself. Examples of these include common area maintenance charges, security services, providing an operator, such as a pilot to operate a plane that's being leased, or a driver for a truck that's being leased, maintenance services on a leased asset, etc. Even though these costs may be negotiated and included in a lease agreement, payments in this second category are accounted for under other GAAP, not under ASC 842. The third category is non-components, meaning that they are not components like the first 2 categories we just described. Non-components represent costs of securing an asset, but don't transfer a good or a service to the lessee. Classic examples of this are property taxes and insurance. There's another new accounting activity involved here, which is taking these non-component payments and allocating them into the prior 2 categories I just described. To allocate non-components, lessees will look to observable data to determine the relative standalone fair values of the lease and non-lease components from the first 2 categories, and then allocate this third category of non-component costs into those categories based on their relative fair values. Once allocated into those categories, components will be accounted for as additional payment amounts that are absorbed into those components. And if you're a little confused, don't worry, we'll have an example. But let's acknowledge that this can be fairly involved. Having said all of that, the FASB provided relief to companies who choose not to go through this allocation process by allowing an optional policy election. The available election allows companies to combine lease and non-lease components together, and it takes away the need to do the relative standalone fair value assessments. We prepared a simple example and some diagrams to depict how this works, and also introduce a little bit of additional information while we're at it. On this page, we are summarizing the accounting treatment of the 3 payment types introduced on the prior slide, both for the standard or default accounting scenario on the left, and for the scenario if an entity makes the election to combine lease and non-lease components. You can visually see the similarities and differences. From the first row in blue and the middle row in yellow, the processes of identifying lease-related payments and categorizing them is the same under both scenarios, as is the middle box process of aggregating them together as contract consideration. Here is where I will provide an additional aspect of the rules. As noted by the asterisk in the top row, which is small but important, payments that are part of contract consideration include payments that are fixed, as well as payments that are variable if they are based on an index or some type of rate. What is not part of contract consideration is payments that are variable and not based on an index or rate. A common example of this is payments that are based on reimbursing a lessor for its actual costs. For instance, a requirement for a lessee to pay property taxes on a real estate lease based on the actual bill that will ultimately be received by the lessor in the future. Another common example is variable payments on a real estate lease based on whether the lessee's sales exceed certain thresholds, or rent based on a percentage of sales by the lessee. These are variable payments that are not based on an index or rate, and they are allocated to their lease and non-lease components in the future when they become known. For the standard scenario on the left, once contract consideration has been determined, it's allocated to lease and non-lease components on the basis of their relative standalone fair values. However, for the scenario on the right, when an entity has made the optional policy election to combine lease and non-lease components, there is no allocation necessary. All of the contract consideration is combined together, and it's all accounted for under ASC 842. Because these concepts are new and can be confusing, we put together a very simple example on the next slide. In our hypothetical example here, we're modeling the lease of a truck with the following payments dictated in the contract. We have base rent of $50,000, which represents the lease component in the agreement. Next, we have maintenance charges that are fixed at $7,000. This represents a non-lease component since payments for maintenance are not necessary for use and control of the truck itself, yet they relate to the use of the truck. Finally, we have property taxes of $3,000. In the asterisk, we explain that property taxes in our example are estimated to be $3,000, but they will be trued up to actuals. Based on this, property taxes are variable, not based on an index or rate, so they will be excluded from contract consideration. On the left side in the standard accounting model, hopefully you can read the small text in blue boxes to notice that the lessee went through a process to determine relative standalone fair values of the elements of the lease. In this process, the lessee used observable data to essentially determine what the unbundled market-based payments would have been for the lease of the truck if it had not been leased, if it had been leased without the maintenance agreement. And likewise, what the unbundled market-based payments would have been for the maintenance services if those had been separately secured on their own. In the upper left blue box, our hypothetical example shows that the lease payments in the lease are $50,000, but the standalone fair value for those is $55,000. In the next blue box to the right, we see that the maintenance payments of $7,000 in the lease have a standalone fair value of $10,000. Then the lessee does some simple math to calculate the relative percentage of those fair values attributed to the lease and non-lease components, which are 85% and 15% respectively. Those relative percentages are used to compute the allocation of contract consideration into lease and non-lease components in the gray boxes at the bottom. The result for the scenario is that the lease component has a value of future payments totaling $48,231 that will be accounted for under ASC 842. The non-lease value of $8,769 will be accounted for under other GAAP outside of ASC 842. On the scenario on the right, where the entity elects to combine lease and non-lease components, there is no need to determine the standalone fair values of contract elements. There's no allocation of contract consideration. The resulting combined lease and non-lease component value of future payments totals $57,000 that will be accounted for under ASC 842. Comparing the processes and results, you can see that by making the policy election with the scenario on the right, things are a bit easier from an accounting and administrative perspective. That is the upside. However, you can see in the gray boxes at the bottom, the downside is that the amounts used in the ASC 842 calculations of ROU assets and lease liabilities are larger, and most entities would generally prefer that these amounts be smaller. So there's a pro and a con here to making this policy election. In applying the guidance we just talked about pertaining to lease-related payments and components, your organization may have certain leased assets that lend themselves to application of what is called the portfolio approach. Under this approach, entities may combine similar lease components together for ASC 842 accounting purposes. This is generally applicable to leases that include multiple assets that are the same or similar. Think of a lease for a fleet of vehicles or a contract for multiple copy machines where each vehicle or copier in the lease has the same start and end date and the same general terms, such as options to extend the term or purchase options, etc. By applying the portfolio approach, an entity effectively condenses the number of lease accounting units by setting a group of assets as one unit of accounting. This can have the advantage of streamlining the accounting effort by carrying out calculations and journal entries for one group of assets as opposed to multiple individual assets. However, before deciding to apply this approach, preparers should think about the possibility of any individual assets in the portfolio to terminate early or to extend beyond the initial established lease term. Changes in circumstances that would impact only certain assets within the portfolio may cause extra accounting work in the future if they need to effectively be unbundled from the portfolio and then accounted for separately. So this is something to at least consider before deciding to apply the portfolio approach. Okay, we're moving to the next step in applying ASC 842. We're ready to classify leases. This table is a summary of classification criteria from both the lessee and the lessor's perspectives. You can see the general symmetry between lessee and lessor classifications. We're focusing on the lessee aspect in our discussion, as lessee accounting is really where the biggest changes have come from ASC 842. To reiterate a key point, all identified leases will be represented on the balance sheet with ROU assets and lease liabilities, regardless of whether they are classified as finance or operating. If any of the 5 conditions in the top middle blue shaded section are present, the lease is a finance lease. If none of those criteria are met, then the lease is an operating lease to the lessee. The criteria used to classify leases are largely the same as they were under ASC 840, but we'll point out a couple of changes that are noteworthy. We'll skip right to the third criteria, which addresses whether the lease term is for a major part of the remaining economic life of the asset. Under the old guidance of ASC 840, there was a 75% threshold in place, but that bright line threshold has been replaced with the phrase major part, allowing the use of judgment. And although the 75% threshold was removed as a requirement, the FASB recognizes that use of 75% as a guidepost is a reasonable approach. In assessing this criteria, lessees need to include lease terms that are reasonably certain to occur. This includes options to extend or terminate the lease. We'll talk about the fourth criteria in a little more detail on the next slide. So we'll move to the fifth criteria, which is new within ASC 842. It indicates that if a leased asset is so specialized in nature that it is expected to have no alternative future use to the lessor, it would constitute a finance lease. Here on this slide, we just wanted to go a little deeper into the classification criteria constituting substantially all of the fair value of the leased asset. A lease would be a finance lease under what was listed as the fourth criteria on the prior slide, if the present value of the lease payments represents substantially all of the fair value of the leased asset. Under the old ASC 840, there used to be a 90% threshold specifically set forth in the accounting literature. Under ASC 842, this 90% threshold is removed. Preparers can apply judgment when deciding this criteria. However, again, the FASB acknowledges that reverting back to use of the 90% threshold would be a reasonable approach. We wanted to call out this criteria specifically so we could highlight the costs that are included in the payment stream that will be present valued and compared to the fair value of the leased asset. The lease payments include the following: all fixed payments paid in the past or payable in the future under the contract. You subtract from this any lease incentives paid or payable to the lessee. You include the exercise price of a purchase option if it's reasonably certain to be exercised. You include payments for an early termination penalty if termination is reasonably certain to occur and reflected in the lease term. You include fees paid by the lessee to a special purpose entity for structuring the lease transaction and the total amount possible of being owed under a residual value guarantee included in the contract. Companies will schedule out all of these payments, apply a discount rate to be discussed by Greg shortly, and calculate the present value of the stream of those payments. So with that, we just addressed how to identify leases, including embedded leases, how lessees should accumulate and categorize payments that relate to leases, and how lessees should classify leases as finance or operating. Now for our second polling question.
Thank you, Cheryl. So those are some of the more complex area of the ASC new standard. So the second polling question, how many leases does your organizations have? 0, I don't know why I'm here as an option. 1 to 20 leases, 20 to 50, 50 to 100, or 100 and over. So now that Cheryl has covered some of the more complex areas of the new lease standard, especially with the service contracts, embedded leases, it's likely that although you have in the past, you would have thought, okay, you had not many leases. If you look at the service agreements, it's likely that you have more leases than you think you have, because some of the contracts, the term lease may not be there, but still if it meets the criteria, then potentially you have a lease. All right. Wow, overwhelming, 1 to 20. So again, I think at least for our clients, that will be where we think most of our clients will be with 1 to 20 leases. So that's not a surprise answer. Thank you all for answering the polling question. I think the next session, Greg will take over. Greg?
All right, thank you, Silas. 1 to 20, I think, is pretty expected. That's where we've anticipated most of our clients falling. And we'll get to in a minute the lessee ledger tool that we've developed. But that's a big reason that we developed it, is we expect there to be a lot of clients that fall into that smaller lease portfolio and needing a solution that fits with their organization. So we'll get to that in a minute. But as Cheryl mentioned on the last slide, you're required to use a discount rate to calculate the present value of the lease payments in order to determine lease classification. And so there are 3 options that we wanted to cover briefly. The first is the rate implicit in the lease. Lessors are always required to use the rate implicit in the lease. They have the information to determine it. Lessees are required to use it when readily determinable. And so it's not likely to be readily determinable outside of related party lease situations, because certain parts of the information needed are only known to the lessor. So the lessee is not required to make estimates of those amounts or try to come up with implicit rate without having knowledge or ready access to that information. But because it will be a factor in related party leases, and we know a lot of our clients have related party lease situations, we do want to cover it in a little bit of detail. The rate implicit in the lease is the rate at which the present value of the lease payments plus the present value of the residual value of the asset equals the fair value of the assets at commencement minus any related investment tax credits retained by the lessor, and then any deferred initial direct costs related recognized by the lessor. So it's not a straightforward calculation. You've got to do a little bit of algebra if you go back to high school and figure out how to work out that calculation. But we actually have a tool that will assist with that we'll show you towards the end, and that's available to any of our clients. Reach out to your Sikich contact, or if you don't have one, we'll give you other ways to contact us, and we're happy to share that with you. The second option, and more likely to be used, is the incremental borrowing rate, which is the rate of interest that a lessee would have to borrow to pay to borrow on a collateralized basis over the same term, an amount equal to the lease payment. So if you wanted to go out and purchase the asset, what would a lender charge you to borrow money for that lease term if you're going to repay it over 5 years or 7 years? We see a lot of companies default to like a line of credit rate or sort of their next marginal borrowing rate. What do they have available? That may or may not be right given the circumstances, and so that's something you really need to consider. Have you gone through the appropriate steps to determine what you would have to pay at commencement to borrow those funds? Again, not the easiest calculation. You may have to look for tools or reach out to your bankers or lenders if you have good relationships to get an estimate of that rate. But the easy option for non-public companies, if you choose, is to make an accounting policy election to use a risk-free rate, which is essentially the rate of return on a zero-risk investment like U.S. Treasury bonds. You do need to use a rate that reflects a similar time period as the lease term. So if it's a 10-year lease, you need to use a 10-year bond to determine what that appropriate discount rate should be. And just about a week ago, the FASB confirmed that this election can be made by class of underlying asset. And the advantage there is that you can choose to use the risk-free rate for high volume, low dollar items like office equipment or potentially vehicles, while still using an incremental borrowing rate for maybe lower volume, higher dollar like real estate leases. The impact of using a risk-free rate is because that rate is generally going to be much lower than the other rates. The calculated liability is going to be higher. And so, there will be some decision making there as to what classes of underlying assets you would choose to apply that to. Also, with the FASB decision about a week ago, they also reaffirmed, though, that even for related parties who make the risk-free rate election, or for any entity, I suppose, that makes the risk-free rate election, you still have to use the rate implicit in the lease if it's readily determinable. So again, related parties who may make the risk-free rate election can use that for leases with unrelated parties, but they're likely going to have to still use the rate implicit in the lease for their related party leasing activity. So with that, now we can kind of jump into a quick example, and we wanted to be able to demonstrate to you how the Lessee Ledger tool helps with determining whether or not you meet any of these classification criteria. So I'm going to run through an example here. I'm going to pull up our tool, and this will be a brief glimpse at how it works, and we're certainly going to dive into this a lot more in the next session. But a quick overview of the Excel tool that we've developed relies on a number of macros and built-in logic to automate the calculations, and then summarize information into journal entries, disclosure information, roll forward schedules. But to quickly run through an example here, we can add a new calculation worksheet simply by clicking the button and start filling in the inputs. We have a user guide that does help walk through what the inputs are, what information is necessary, and then what's required and what's optional depending on your circumstances. So we're going to use the information on the last slide and look at the lease classification for a hypothetical vehicle lease that for this, we're going to start it on our adoption date, a 5-year lease. So we'll put in 60 months. Our payments are due at the beginning of each month. We'll assign a 5% discount rate. Maybe we'll assume for this purpose that is we determined our incremental borrowing rate. Our vehicle has a fair value of $35,000, and we'll say an economic life of 84 months. These two fields are not required to perform calculations, but they are necessary to help illustrate whether or not you've met the major part of the economic life or substantially all the fair value threshold. You then come over and we can input our payment streams For the example here, we're going to use the tool to automatically calculate out what our payment schedule is based on a fixed percentage increase each year, and the first increase being on the anniversary date of the lease and each year thereafter. So with that information, we've started to calculate out what our lease liability is, but we can't finish the calculation of the ROU asset until we classify it, the rest of the schedule. And so we've provided this table here to help you perform that classification to make the analysis. In our table, we said there's no transfer of title, there's no purchase option, and it's not of a specialized nature. So we cross those off. Those are pretty easy, as stated. We then come back to, is it a major part or is it substantially all? And those thresholds now are going to vary based on what your entity elects. But if we continue to use the 75 and 90% thresholds, we'll answer no to both of these. The tool here, based on the information you've input, will look at the lease term compared to the economic life, and we'll also look at the calculated net present value compared to the fair value of the asset to make those calculations for you to streamline that exercise. And so we can use this to quickly make that assessment. If we were to add in a potential residual value guarantee, we'll say at the end of the lease, we're guaranteeing the lessor that it'll be worth at least $5,000. We've added nearly $4,000 to our lease liability for classification purposes, and now we're over the threshold. So, if we use 90%, we'd have to respond yes, and we would have a finance lease there. So that's a quick illustration of going through that process to determine whether you meet the thresholds and how this tool can help you walk through that. In the slides, we've included screen captures to illustrate those. A couple of topics that I know a lot of people are interested. There's a lot of conversation about. The first one being related party leases. How do we get out of doing 842 accounting for related party leases? And the standard's very clear that related party leases are not exempt, that they are to be accounted for based on legally enforceable terms and conditions. And the expectation is that would be the same as if the lease were between unrelated parties. There would be no difference in the way that it's accounted for simply because it's between related parties. The question also often becomes, well, it's short term. I have a month-to-month lease with my related party, and so I don't have any legally enforceable terms and conditions, do I? It's short term. We will just recognize it, and that may or may not be true. There are a number of indicators that should be considered that you'll look at to say, do I truly have a month-to-month lease, or is it just structured to be month-to-month? Are there other agreements or other conditions which suggest there was an agreement between the related parties? One of those might be the existence of significant leasehold improvements. If you have leasehold improvements that you're amortizing over 7 years, but you say you have a month-to-month lease, those are very inconsistent conclusions. Oftentimes we'll see footnote disclosures or something to the effect that the related party will reimburse them for any unamortized leasehold improvements if the lease were canceled. And in that case, that essentially becomes a termination penalty. That indicates that there is an agreement between the related parties that the lease will continue as long as the leasehold improvements, or the lessor will have a penalty for early termination. So that is one example. The definition of a lease actually includes portions during which there are debt guarantees. So if there are guarantees of the debt that finances the underlying asset between the parties, that may be indicative that it's more than a month-to-month lease. Or, for example, the economically disruptive or commercially unrealistic to move the operations. If you have a call center or an office with salespeople that they can pick up and move to another location pretty easily, maybe it truly is a month-to-month, that there's not an expectation beyond that. But if you have a significant manufacturing or logistics operation that requires specialized equipment and a specialized facility to hold that, and it would take a significant amount of time to relocate, the question, would you really enter into a similar month-to-month lease with a related party? Would you put yourself in a position to have to maybe move in a month? Is that realistic? So none of these conditions themselves necessarily indicate that there are legally enforceable terms or conditions, or that it would have to be more than a month-to-month lease, but there's certainly things that should be considered. We recommend that clients define their related party leases, put terms to them so it's clear, to get rid of the ambiguity. If you want to put on a 2-year term and that's reasonable for that underlying asset, that it takes away some of the effort in determining, is it truly short to term? What do I need to do with it? In any event, the guidance does recognize that accounting for related party leases can be difficult because it is based on what's legally enforceable. That may require a legal determination. You may need to consult with your attorney, but there is some leeway as to those expectations, and you're still required to disclose all of the related party disclosure information regarding these transactions that provide users the information. We talked a little bit about the discount rate and how related parties will likely have to use the rate implicit in the lease. And often that rate is going to be very high, abnormally high compared to leases between unrelated parties. For example, on a vehicle lease, it may be structured that the lessee repays the lessor for its entire investment in the asset over 3 years, plus the lessor gets the asset back at the end of 3 years. That is going to result in a very high implicit rate. It could be 20%, which you're not normally going to pay any other party. So that's something to be aware of and not be surprised by when you do determine those implicit rates. The impact of that then potentially on lease classification is that the higher the discount rate is, the lower your net present value of lease payments is going to be. And that can affect whether or not you meet the substantially all the fair value threshold. If you set one threshold for your organization, if it's 90%, using a 20% discount rate on a lease could make that calculate out as 80%. And so there are considerations there as to what for your entity represents substantially all the fair value. We're happy to work through those considerations with you as they become an issue or apparent for your organization. But a few things that we wanted to point out there: that related parties are included, they're not scoped out, and there are some unique considerations there that you'll have to work through. One of the other areas that there's a lot of interest in is just transition, day one. What do I need to do to get ready? What are the first steps? And so Silas early on talked about the transition methods where you can have comparative reporting or non-comparative reporting. We do expect most companies will choose to go with the non-comparative reporting because you only have to do the calculations for 1 year. You don't have to do the calculations for the comparative period. But it'd be important to understand how that impacts the users of your financial statements. You make sure that you're on the same page with them, that they understand that there are going to be, there's a lack of comparability in the annual financial statements in that first year, as well as any interim reporting in the first year. You're not required under GAAP to adjust your interim statements for ASC 842 until the second year. So anything on an interim basis, like covenant calculations, compliance certificates that you may have to do on a monthly or quarterly basis, even though the standard's effective, won't reflect 842 until the second year. Next is to consider the practical expedients that you'll choose. There's a package of 3 that you have to adopt all of them together. This is a good expedient because you kind of get to pick up where you left off. You don't have to go back and reconsider things, whether or not an existing arrangement contains a lease, what the lease classification is, and the treatment of any initial direct costs. That definition of an initial direct cost was narrowed under 842, but you don't have to go back and change anything about how you handle those under 840. The one caveat with this is it doesn't grandfather in any incorrect assessments. So if you didn't identify an embedded lease under 840, you do need to identify that now and account for it correctly under 842. Hindsight is questionable. This is one I think that, they call it a practical expedient, but the general consensus is that it may not really be an expedient. So you should look at this one carefully if you think that you want to adopt it. It allows you to go reconsider any renewal terms or purchase options, information that you have up through the adoption date, but you have to do it for all leases. It's an all or none. And so there could be a good amount of effort there to apply that practical expedient. And then easements, whether or not any existing land easements are contained leases. If you accounted for land easements as a lease under 840, you have to continue doing that, but otherwise you don't have to relook at land easements under 842 if you adopt the expedient. On the transition side, just quickly to kind of give you an idea of where you're going to start, if under the package of 3 expedient, your lease classification is going to stay the same. So we expect most will adopt that. If you had an operating lease under 840, it'll continue to be operating under 842. And if you had a capital lease under 840, it'll now be called a finance lease under 842. With those operating leases, you'll measure your lease liability and right of use asset at the application date of the standard. So not going back to the beginning of the lease commencement, but as of your application date of the standard, and recognize those assets and liabilities. You'll then have to adjust any carrying balances from 840, such as prepaid rent, unamortized incentives, into your right of use asset under 842. And then for capital leases that become finance, you really just start with the carrying amounts from the accounting under 840 for those balances. So what was your capital lease obligation will now become your finance lease obligation. You'll pick up where you left off. And again, that assumes that those calculations were done correctly. If not, there may be some adjustments needed if the differences or the errors were significant. And then in addition to the disclosures in the standard in the year of transition, there will be the other standard transition disclosures required by ASC 250. I think we have another polling question.
Thank you, Greg. So let me read so I think there's a typo there. How do you plan to prepare and maintain lease accounting calculations? The options are internally developed spreadsheets. I'm interested in Sikich's Lease Ledger, looking at a variety of other third-party applications, already selected a third-party application. So those are the 4 options to answer the poll. Just FYI for all of you, Greg is the architect of the Lease Ledger tool, and I personally believe that's an amazing tool that he's built. And I know Greg will walk through that tool a little more or much more during our second session, which is scheduled on October 7th. So let's see what the results are for this polling question. 58% is a clear winner. I'm interested in Sikich's Lease Ledger. That's great. And like I said, we will do more demo of that tool in the next session on October 7th. Plus, for all of our clients and prospects, we would work with you directly to discuss, provide more information regarding the Lease Ledger. So go ahead.
Okay, no, that is good to hear. So join us next time. You'll get some more detailed views and reach out to us. We're happy to meet with you and discuss, whether Lease Ledger works for you. We think it'll work for most. So with the couple of minutes that we have left here, just an overall reminder of the implementation process. This is really a big process. One of the biggest lessons learned from early implementations in public companies is it takes more time than you would expect. And unlike 606, ASC 606 with RevRec, you are going to end up in a different place. Your income statement may not change significantly, but your balance sheet certainly will if you have leasing activity. There are a number of steps here. We have some tools that we want to share with you that we have available to help with that process. Through our website, you can connect with us. We've got links to several good resources. We have insight articles. If you follow us on LinkedIn, I'm sure you see some of these pop up every now and then, but they drill down into some specific areas. You're able to download our lessee handbook. This is sort of a Cliff Notes version of the standard. It's about 30 pages compared to several hundred if you were to print out the actual text of the standard. Many hundreds if you look at other resources. So this is a high-level overview. It gives you the base knowledge that you need to get comfortable with the standard. And also includes a policy election template at the end to help you identify what those decisions are that your organization needs to make and to document those. So, feel free to use this or some other format, but this is a great shortcut to get you there. And we've talked about most of those today. We have a data collection tool. We've talked about there is an immense amount of data that may need to be collected, and you want to be organized in doing that. So again, there's not many tools out there like this that are easy to find or locate. We're happy to share this with you to help you get started. We've talked about implicit rates and calculating what those are. Again, we have a tool where you can input your lease terms and simply press the calculate button. This is an example that I mentioned earlier, related parties, you might end up at 19%. And finally, the lessee ledger tool that we talked about a bit this time. We'll talk about this quite a bit more in the next session, which is our webinar series. We'll go over recognition, measurement, subsequent accounting, and reporting on October 7th. If you haven't registered, please do. We have a great group today, a nice size, and we're happy to be able to share this information with you and look forward to that next session. So our contact information is up here on the screen. Again, we appreciate you joining us today for your time. Any questions? I know we ran out of time here. We had a few questions. We will respond directly to people that have questions. And if you have a question you get to ask, there will be a post-webinar survey you can fill out, submit those questions, and we will get back to you as soon as possible on those. CPE, if you've answered the polls and you do the survey, you'll get your CPE certificate within 2 weeks. And for anybody that wasn't able to make this or sit through the entire presentation today, we'll have a recording up on the website in the near future. So feel free to reach out to us. Call your Sikich contact, reach out through our website, reach out to any of the three of us directly. We're here and happy to help and provide more information as needed. So I think that concludes for today. So
thank you, Greg. Thank you, Cheryl. Thank you all for attending. Hope to see you all on October 7th.
Everyone.
Bye-bye.